mode.
Neil, I thought just as we wait for the final few people to get online, and we've got a few moments to ensure that all the attendees are on board, I thought it'd be interesting just to get your thoughts on the subject 5 years on from the start of the GFC. What changes have you seen in regards to how investors and advisors act regarding their investment decisions? And from those changes, what effect has it had, if any, on the way you view and manage Australian equities?
Well, the big thing which has affected investors and advisors is the fact that they remember the GFC. Most of them very, very strongly, because it cost a lot of people a lot of money. And in behavioural economics, there's this thing called recency, which really just says that we are most affected by the things which happened most recently. That is, before the GFC, up to 2007, we'd had 15 good years, fairly steadily rising markets, fairly strong economy and so forth, and we believed that that was going to be the future. Since the GFC, though, we've had a big shock, a lot of currency turbulence, economic turbulence and so forth. So now most investors believe that that is going to be the future. That is, they have not a bearish mindset necessarily, but in some cases very bearish, but certainly a nervous mindset. They're worried about what's around the next corner. And this is a good thing in the sense that it improves their prudence and controls their risk-taking, but it also means that they are now blind to a lot of the upside. Whereas before the GFC, it was very hard to persuade anyone that there was downside in the market. These days, it's pretty hard to persuade people there is upside in the market.
It's certainly been a very interesting time. Well, we might get underway, and thank you everyone for attending today's webinar entitled How to Escape the China Slowdown. This webinar is presented by Neill Colledge, the Head of Australian Equities at Millinium Capital Managers, and is the first in an ongoing series that the team at Millinium will be hosting. My name's Noel Lord, and I'm going to act as the facilitator for today's webinar. Look at just a couple of housekeeping points before I hand over to Neil. If you are using an iDevice, an iPad or iPhone, etc., you will not be able to answer the poll questions at the conclusion of the webinar, and therefore we'd ask that you email your thoughts into the team at Millinium so they can capture all the feedback to ensure that future events hit the mark for you all. You will have the opportunity to ask questions of Neil throughout the presentation by clicking on the question box that appears on your screen. I will be collating the questions and have Neil address them at the conclusion of this presentation. To ensure that there's no background noise, we've made sure all attendees will be muted throughout the presentation so that everybody will get to hear what Neil has to say. So let me now introduce Neill Colledge to you. Neill Colledge has over 30 years experience of using qualitative and quantitative methods to assess companies and industries. He had 17 years with QIC and in that time managed $11 billion of Australian equities, which outperformed the ASX S&P 200. With expertise in equities portfolio management, on top of that, 12 years experience in institutional stockbroking as a research analyst, including participation in equity capital markets and M&A, along with extensive experience and practical knowledge in assessing and managing credit, investment, market and operational risks. Neil is well versed to be able to talk to us today about surviving the China slowdown. He's been managing the Millinium Capital Managers Australian equities portfolio now for 5 years, and in that time has delivered significant returns to investors. This portfolio recently was awarded a 5-star rating from Morningstar and has delivered in excess of over 35% over the last 12 months and above 14% for investors over the last 3 years to the end of March. And I know this is something that both Neil and his team are rightly proud of. What I would like to do now is to hand you over to Neill Colledge, Head of Australian Equities at Millinium Capital Managers, to talk to you about surviving the China slowdown, or how to escape the China slowdown, sorry. Neil, over to you.
Thank you very much, Noel. China is a big country, so any question about the Chinese economy is going to be a huge topic. So I'm going to try and focus on a handful of things which I consider the most important factors, but there are a whole lot of other things which are almost as important. So if you want to ask about something which I haven't covered, please feel free, please go ahead. It's very clear from the last couple of years of economic statistics that China is slowing down. Growth rates have dropped slightly from the average of 9% per year for the last 30 years down to only 7.5% in the latest quarter. What's happening here is actually fairly straightforward. China has had an investment-led growth model which mimics that used in Japan and Korea and Taiwan, all of which had slowdowns eventually, and the slowdown is now happening in China, basically because you can only shove so much new investment into an economy before you begin to waste money. We'll come back to that in detail later on. What's going to happen over the next 5 years is that growth will come less from heavy industry, things like steel, chemicals, cars, etc., and more from the consumption side and the services sector. In addition, the Chinese government is embarking on a reform program which is designed to improve the welfare of the Chinese people by extending healthcare benefits, old age pensions, and particularly reducing China's fairly large environmental problems. As a result of this, China's government deficit is going up by 50% this year, from 800 billion renminbi to 1,200 million renminbi, which is 2.7% of GDP. And that makes Wang Swan's deficit look very small indeed. Now, it's important to remember that the government knows perfectly well that China is slowing down. You've been officially warned by the central bank governor, by the Standing Committee of the Politburo, which is the 7 most important people in China, and the State Council has officially announced its reform program, which is designed to improve the lot of the Chinese people, improve food safety, etc., etc. And all this is going to cost money, and they know it. I'm only going to show you 2 charts out of the many hundreds we could talk about. This is really the key to where China is going to go. If you look at this chart, you can see the bottom line with the dots. It shows aging population and how that's rising. This is a result of rising life expectancy in China. It basically means that people live longer and therefore you have more elderly people, more people over 60. At the same time, as an effect of getting richer and more urbanized, you have fewer children per family. This is essentially because if you're an urban household, you might want 2 kids. You don't need 5 or 6 kids to work on the family farm. So if you add these 2 lines together, aging population, i.e. more elderly people, fewer kids per family, i.e. fewer children, you end up with the thick line on the top, which is labeled demographic bonus, demographic onus. And that's the working age population, people aged 15 to 59. As you can see, for the last 50 years odd, the working age population has been rising fairly steadily. This is positive for the Chinese economy. Recently, however, it has begun to flatten out, and what will happen over the next couple of decades is that it begins to slow down. That is, you actually get a reduction in the working age population. Now, that's not intrinsically bad, but it does have one important consequence: rising wages. At this point, I have to mention a small digression on a thing called the hukou system, which is often called resident permits. If you are a citizen of China, you get a residence permit for wherever you were born. If you're born in a city, you have a city residence permit. If you're born in some village in the countryside, you have a countryside residence permit. And it's only recently, only in the last 2 years, that more than 50% of China's population actually lives in the city. So most people in China actually have a countryside hukou. Now, the importance of this resident permit is that if you only get social services if you are in the place where you have your residence permit. If you're born in a village in the countryside, you can only get your kids going to school for free. You can only get free healthcare. You can only get any social services if you are in that place. So if you're a resident of a country who moves to Shanghai or something, you will not have any social services in Shanghai, full stop. You'll have nothing except what you buy yourself. You want to send your kids to school, it'll cost you money. And this is why there is a flaw in Chinese urbanization at the moment, that the 250 million so-called migrant labor, people who move from the countryside to the city, don't have urban residence permits, so they don't get urban social services. This makes them very, very cheap citizens as far as the government is concerned, but it does cause an eventual problem. The first problem is that now that people are no longer desperate for higher incomes, they're no longer that keen to move from the countryside to the city. And you've seen in the last 2 years that people are not willing to work in factory assembly lines for 16 hours a day. They want to work in white-collar jobs, they want to work in service industries, they want to work in things with better status, higher income, better conditions, and so forth. And this is why private sector wages have been rising very fast in the last couple of years. So this is not necessarily a killer for the Chinese economy, but it does mean that China is not going to be a low-wage economy, not going to be a cheap production economy for much longer. The other key factor in the Chinese economy at the moment is that there has been a massive overinvestment in physical assets. And this is because the investment-led growth policy specifically favoured companies, particularly state-owned enterprises, investing in big, solid assets. They were encouraged by the depreciation system, they were encouraged by cheap loans from the banks, and this means that there are, in fact, too many physical assets. There is over-formation of physical assets. It's dropping slightly from where it was a couple of years ago, but the net result is that China's capacity utilization has dropped to as low as 60%, and this is an IMF report, compared to a fairly normal 80% odd before the GFC. And this is essentially because China has solved its GFC problems by a big investment surge, but a lot of this investment dollars have been wasted. The same thing has happened in infrastructure. As part of a 2008 stimulus, which was absolutely huge, 12% of GDP, local governments were encouraged to build all kinds of infrastructure. And this was to really get the economy going again, to replace dropping exports, to make sure that there wasn't a sharp rise in unemployment and so forth. But what happened was that, in part, some of the new infrastructure was substandard. You've heard about crashes in the very fast train system, highways collapsing, etc. The bigger problem is that many of these infrastructure projects are not commercially viable. They don't have enough cash flow now, and they won't in the next few years have enough cash flow to service the debts they've taken on, because almost all of these projects were debt funded. If you look, for example, around Brisbane, you'll see the River City Motorway, Clem 7, and you'll see the airport link and many other exciting, useful pieces of infrastructure which don't make money, which have already been into receivership, and there's very little prospect of them actually making enough to repay the amounts that were spent on building them. China is a lot larger than Brisbane. There are thousands of these infrastructure projects which are perfectly good bridges, highways, tunnels, etc., but they're never going to repay the money which was spent on building them. This you can see in the amount of debt which China has incurred in the last 5 years. Until the end of 2008, when the big stimulus came along, China's debt was at pretty low levels, less than 150% of GDP. This is pretty low globally and historically quite low for China as well. What happened as part of a stimulus, and the fact that this was almost entirely funded by bank credit, is that debt rocketed, and it's still going up. It is not coming down in a hurry. This means that eventually debt is going to be a time bomb for the Chinese government. You can see that the banking system has quite a lot of bad loans. The official figure is only 1% so far, but you are going to see more bad loans in future, because to date all the bad loans in infrastructure have been rolled over in the hope that they will improve. But credit is still growing. The banking sector is still making loans, and a lot of the time it's still making bad loans. This is what wealth management products are. They're high yield loans. They're loans which are made to projects which are supposed to produce high returns, and they're sold to investors who want high yields. And they're not on the bank's balance sheets. And these are still growing. They grew by 66% last year. So what's happening is that the banks are cleaning up their balance sheets, mostly by putting the difficult stuff off balance sheet. Now this, and I emphasize this, I cannot emphasize this enough, this does not mean that China is going to face a banking crisis like the US or Europe or anything like that, because you have to remember that the big four Chinese banks are not commercial banks. They may be listed, the government may be a shareholder and so forth, but these banks, the big four banks which account for nearly half of China's loans, were in fact created by the government in the 1980s for the primary purpose of financing what the government did. The senior executives of these banks are not ordinary guys who work their way up from being bank tellers or anything like that. They are high Communist Party officials who happen to have spent a career in banking. Their key positions are not the fact that they are, say, CEO or chairman of the bank, but they are instead party secretary of the Communist Party in that bank. And after they stop being bankers, they will go on to higher positions in the Communist Party. That is, the banking system is run by the Communist Party for the Communist Party. This is not going to be allowed to fall over at any point. The last time, in the late 90s, when the banks got into trouble through bad loans made to state-owned enterprises, the central government conducted a refinancing which essentially gave the banks more capital, took the bad loans off their books, and off they go again. And this will happen again this time too. But the consequence of this, or any refinancing, is that someone has to put in the money, and it's going to be the central government, so there's going to be more debt on the central bank's own balance sheet. Again, this time bomb idea. Now, we're not saying that there's going to be a China crash. I know that there are a lot of bears around the world who said, well, there's going to be a property crash because Chinese housing prices are in a bubble, that the overcapacity is going to mean huge shutdowns and so forth. There's going to be a banking crisis. No. It's not that bad. The time bombs aren't about to go off. The government knows they're there, and it's working on solving them. If you're a China bull, you can say that the government has succeeded in running a high-growth economy for 30 years. Why can't it keep on doing this? Well, we're not that optimistic, but we do think there is going to be a slowdown to around about 5% growth, i.e. half what the growth rate was over the last 30 years. And this is driven by the need to shut down a lot of this excess capacity and to write off a lot of the bad debts, although the government will come in and rescue most of the local government bad debts. And at the same time, as we mentioned right at the start, the policy of reforming the economy to improve social services and make consumers better off also imposes extra costs. So we expect a slowdown rather than a crash. A crash is not impossible, but certainly not going to happen straight away. Mismanagement by governments can always produce disasters, but in this case, because the Chinese government is very much aware of its problem and is already moving to deal with them, we don't think that the time bomb's going to explode in their face. They have 3 to 5 years in which to sort this out. One of the key things about China as well is that the smart money is leaving town. It's been leaving town for the last few years. Some of the commercial banks do surveys of their clients, their very rich clients, and they've discovered that some 60% of them either have changed their domicile, they're now officially residents of Australia or Canada or the US, or they're planning to leave sometime in the near future. The motivations for this are essentially they would like to protect their assets. They don't want to be solely exposed to the vagaries of Chinese politics, the economy, the government, corrupt officials, this, that, and the other, and also lifestyle for themselves and their kids. They want to go to nice, safe jurisdictions where no one will touch their assets. Here's places, as I said, like the US, Australia, Canada, and so forth. There are estimates for how much money has been leaving China, and as you can see, it's a huge amount over a decade, and it's probably running at about US 400 billion odd per year at the moment. Some of this is corrupt money going overseas. A lot of it is simply prudent wealth diversification by rich Chinese. They still have their Chinese assets, or most of their Chinese assets, but They like to diversify the portfolio by putting a lot of their assets overseas and making sure that a couple of family members have rights of residence overseas as well. Now, the key thing for Australia is that China is our most important economic partner. The country buys a quarter of our exports, and about another quarter of Australia's exports go to other parts of Asia, such as Korea, Taiwan, Japan, Vietnam, which are part of the Chinese supply chain, and they would be affected by China's slowdown. So what happens, even with a modest slowdown to about 5% growth rates, is that you have lower export revenues, hence a lower A dollar, lower mining profits, hence lower tax receipts, and a reduction in mining capex as new mining projects are cancelled, as BHP has just done, hence lower GDP in the long run. So Australia's two-speed economy is going to slow down to a one-speed economy over the next couple of years. For this reason, we avoid absolutely mining. The sector is dominated by the bulk commodities iron ore and coal. There are two biggest exports to China. What we're saying with the slowdown is that the demand for iron ore and coal is dropping, and it will drop further. At the same time as this, you're seeing over the next 3 years new mines coming online from other suppliers, and this will tend to keep prices low. So the outlook for mining is bad. We also think that you should stay away from anything associated with mining. The mining services companies, in fact any company which has more than 20% of its profits come from serving the mining sector in any way, is going to see those profits disappear over the next 3 years. What you see, as I said, is the long-term decline in mining capex as the big miners cease to spend money on new projects and in fact probably cut back their maintenance capex as well. Hence there'll be less work available, more competition. In fact, we expect over the next 5 years the growth in the mining services sector will be zero and quite possibly negative. And I can say from the personal experience of a couple of mining booms that the mining services sector at the end of a mining boom is always a value trap. I know they look cheap, they've got P's of 5 and yields of 10% and so forth the next year or two, but they are cheap now and they will get cheaper in 2 years' time. So what does our portfolio look like right now? Here we have it in terms of a standard sector analysis, which shows that it's reasonably well spread. There are certain absences, like you won't find any media stocks there, you won't find any miners or mining services and so forth, but it's more productive from our point of view to look at it in terms of exposures to various macroeconomic effects. Under domestic regulated, which is more than a third of the portfolio, we class things like the banks and the utilities, industries where you're not guaranteed profits, but it operates in a highly regulated environment. Then there are staple commodities, such as Wesfarmers and its supermarkets, Telstra, because telecommunications, especially if you have teenage children, you will know these are a staple commodity these days, and the more stable operations such as the property trusts. Property trusts now, since they have reduced their debt and cut their distributions back to below the amounts they're actually producing in cash flow. That accounts for 2/3 of the portfolio. That is the cautious, conservative, regulated side of the portfolio is 2/3 of it by value. There is a little excitement in the domestic cyclicals. We class the ASX as cyclical because it does actually tend to move up and down with not just the share market but also with economic activity, building materials related and the travel online retailer, what if. Similarly, international cyclicals, flight centres of international class, because although it gets the bulk of its current profits from Australia, the bulk of its future profit growth is going to come from overseas, particularly the US and the UK. Henderson and international property in the form of Goodman and Westfield Group. So what you have here is a portfolio which is designed to be low risk, because that's how our stock selection procedure works, but it also has quite a significant international exposure and some upside, but we hope with very little downside risk. Before I finish, I have to mention what we're looking for at the moment in terms of the broader economy, because in addition to Australia facing a negative trend as the mining boom ends, and hence the A-dollar tends to fall against the US dollar and the euro, we also expect a global interest rate shock sometime in the next 12 months, and that's simply because the junk bond market in particular is overheated. You've seen CCC rated companies and CCC rated countries issuing bonds at 6 and 7%, and this is really not sustainable. You are going to get some defaults there, and that will cause a little shock to fixed interest investors, which will widen credit spreads and possibly drive some nervous money back to US Treasuries and so forth, but will also serve to remind the equity market that there is risk in equities. And that may in fact be the trigger for some sort of global share market correction. Note, a correction, sort of 10% on, not a bear market. We don't think there's a huge bear market waiting, but we think that Australian equities are a little expensive at the moment. They could do with a correction of the order of 10%, but global equities, it's very much country by country, but the same is true. Global equities have had a sharp rise over the last 12 months, and a correction is pretty much on the cards. But as I said, this is not a bear market. What it is a necessary correction and a slowdown. And what we see really here is that Australia is becoming a less attractive place to invest because it has this negative of the end of the mining boom. But if you look at that from a US or European point of view, the fact that commodity prices falling may be bad for Australians and Brazilians and Canadians and South Africans, resource producers, but a fall in commodity prices is very good for most developed countries, such as the US, European countries, which are users of commodities. So the converse is that although Australia looks not too good, the US in particular looks very good over the next few years. So that is, in summary, our views. If there's anything which I haven't covered or anything which you'd like me to explain a bit further, I'm acutely conscious it's been a very rapid run through, then please feel free to ask questions. And it's over to you, Noel.
Thanks very much, Neil. And for those that may have joined a little bit late, there is the opportunity to ask questions by clicking on the question box on the right-hand side of your screen. And if you type in the question, I'll receive that and be able to ask Neil the questions. Neil, firstly, thank you very much for your very insightful and thought-provoking presentation. We do have a number of questions, and I'll just kick off in no certain order. The first question was, given the present economic environment in China, do you see Australian investors looking more for income or yielding products within Australia rather than investing abroad? What's your view there, Neil?
The natural tendency of Australian investors is to look for what they want inside Australia, and the trouble with looking for yield at the moment is that there isn't very much anywhere in the world. So if you're a yield investor, you should probably stay in Australia, because if you're a yield investor, you are almost by definition a fairly cautious investor, and going overseas, as I said, won't find you anything which is reasonably safe at an above average yield. Certainly you shouldn't be out there buying Peruvian bonds or Chinese company bonds or anything like that. But in Australia you can still achieve reasonable yields from the banks, from the property trusts, from the utilities and so forth. They're not as high as they were 2 years ago or even 1 year ago, but they're still respectable yields. To go much higher than that would really expose you to more risk than you want. But that said, if you can find something which has a reasonably attractive yield overseas, you will probably get some capital gain, particularly in the US, from an economy which is improving faster than Australia, and also from the fall of the A-dollar. So we would really recommend that everyone have quite a significant overseas exposure at the moment.
Thanks, Neil. The next question is in relation to, in today's financial review, there are stories where hedge fund managers are tipping for the A-dollar to come down hard and even betting on that it will come down to circa 60 cents US. How would you think this is going to affect the Australian equities, and more specifically, how will it affect your dividend income fund portfolio?
Okay, let's start with the Australian economy first of all. A fall to 60 cents would be a huge shock, but it is actually a net positive. It makes the remaining exporters who survived look much, much better in $8 terms. It does mean that the price of imported goods would rise very sharply, but remember that you had only 5 years ago exactly the same thing. At the start of a GFC, starting September 2008, the $8 crashed when commodity prices crashed. And for those, anyone had any $8 positions at the time, they will remember it very, very clearly. It didn't do anything terribly bad for the Australian economy, and the negative effects on the share market were mostly linked to other factors in the GFC rather than the fall in the $8 specifically. So a fall in the $8 is not actually that bad for the Australian economy or the Australian share market. It is, of course, very good if you are investing outside Australia.
Great, thank you, Neil. Next question would, you mentioned that as commodity prices fall, so too likely will the $8. Will this soften the impact on mining equities, or are there other benefits and better, safer ways to invest in a declining $8 environment?
Yeah, very simply, the best way to invest in a declining $8 is to invest in US dollars or even euros, not in Chinese renminbi. That would be very, very unsafe at the moment, not because anything bad is going to happen. It's more that the nature of the Chinese equity markets, and I can go into that at great length, but it's not part of the question, so I won't at this point. What you need to remember here is that although a fall in the $8 is good for the miners, it doesn't change the fundamental picture, which is their commodity prices are falling and their commodity export volumes are falling. All it does is act as a translation effect, which makes these things look better in commodity terms. So we're not saying that, for example, BHP and Rio are suddenly going to halve over the next 6 months. That's not going to happen. What we are saying is that they will underperform the rest of the Australian share market over the next 3 years. That is definitely going to happen, and that has less to do with currency translations and more to do with the fact that this commodity super cycle is over, because the China boom is over for a short while. China boom may well come back in 5 or 10 years' time, but in the next few years, China's growth is going to slow down. And if China's growth, say, set plateaus in 5 years' time at 5% per year, it may be signs for an uptick in commodity prices. It may be time to invest in China and so forth. What we're saying is now is not the time to invest in China or commodities.
Thank you, Neil. And for those that can see the screen, you'll see the performance of the Millinium Australian Equities Fund and the consistency of its outperformance of the ASX 200 since Neil's been running this fund for over 5 years. It's given a tremendous return for investors. In relation to the specific portfolio, Neil, how do you weight each of the stocks in your portfolio? That's one of the questions.
We are essentially an equal weighted manager. That is, the fact that we have a view about, say, Flight Centre has exactly the same weight as our view about, say, Westfield Group. We don't think we're a lot smarter about Westfield, therefore we have a higher weighting, simply because it's a larger company. We adjust that very slightly for the extremely large stocks such as the banks and Telstra by putting them in at index weight if we include them in the portfolio, and then putting it our standard equal weight on top of that. Thus, for example, Telstra 4% index weight, and if we have 20 stocks in the portfolio, apart from that, it'll go at another 4% and so forth. So we are essentially an equal weighted manager because we don't think that any of our bets are noticeably smarter than any others. And we think that, I mean, the danger with cap-weighted indices such as the S&P ASX 200 is that they tend to favour recent outperformance, because if a stock has gone up, its index weighting is higher. This is no guarantee, as holders of Apple have just discovered in the US, that it's going to keep on going up. So that's why we prefer an equal weighted portfolio.
Great, thank you very much, Neil. Thank you everybody for logging in today to the initial webinar. In closing the webinar, I would like to draw your attention to the recently announced Millinium PCCP, which is the Private Client Communication Program. This is a new initiative designed to provide the private clients of Millinium with the most up-to-date and relevant information to help assist you in your wealth accumulation journey. This will ensure that you're provided with access to the latest views, commentary and insights from the investment team at Millinium. You can follow the team on Twitter, Facebook, LinkedIn and YouTube. On behalf of Mark Phillips, the Chief Investment Officer, and Neil, I would like to thank everybody for taking the time to attend today and ask that you take 3 minutes of your time just to answer the poll questions that will be up on your screen that will enable the team at Millinium to assess your feedback and ensure that they continue to hit the mark with the content and the timing of these webinars that are planned. Once again, to Neil, thank you very much for your very insightful and thought-provoking presentation, and to everybody for taking the time to link in. We really do appreciate it. So this is the close of the webinar now. Thank you all for coming along. Cheers.